Janet Yellen sees bank earnings pressure, mergers after March crisis. The Wall Street Journal article does go on to say that she doesn't see a huge threat, but that her comments do show that regulators are bracing for turbulence ahead. Whether that's wishful thinking or not on the part of regulators remains to be seen, with bank earnings season just right around the corner in July. We're hoping for the best, but just mergers without any banks getting taken down in the process seems a bit optimistic based on the data we've been pulling together. But as the Secretary of the Treasury, that's probably the most Yellen can say without triggering a crisis of confidence in banks. Why might more banks fail in the coming months? And what can you and I do to protect the hard-earned savings we keep at our bank? That's what I'll be answering in today's video, given the questions and comments you've sent our way about CD safety and some of the what I call goosebump raising rates that seem to keep inching upwards. Because goosebumps was what I got when I did the recent top CD rate videos that many of you asked for, and I don't get goosebumps often. In any case, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Remember when I posted this video on Thanksgiving Day in 2022 and said, and do you know when most bank failures happen? When times are bad and uncertain, like now. And I guess the when times are bad and uncertain, like now, that part still applies nearly 8 months later. In that Thanksgiving Day video, despite not having a crystal ball, I had already addressed the topic of goosebump-raising CD rates. And do you know which banks typically offer the highest rates on their CDs? Those that need the money, those that are, in essence, also the ones most likely to fail. This part is just my personal opinion. You might have a different perspective. I don't feel so much differently about that personal statement now, almost 8 months later. Anyway, then, in that Thanksgiving 2022 video, I showed you this FDIC's bank failures in brief chart for the first time. Silicon Valley Bank, Signature Bank, and First Republic Bank, these here, had not happened yet at that point. What I did emphasize then was that here's where the vast majority of bank failures happened in the past 2 decades, around the Great Recession of 2008-2009. This red line shows the number of bank failures, and the green lines show the total assets held at the failed banks. In 2008 and 2009 alone, there were 165 bank failures, with more than $544 billion of assets in danger of being wiped out. In the first half of this year, we've had only 3 bank failures so far: Silicon Valley Bank, Signature Bank, and First Republic Bank. But in terms of total assets, those 3 banks had more than $548 billion. Yes, the 3 bank failures we've had so far this year, those 3 only had assets totaling pretty much the same amount as the 165 bank failures in 2008 and 2009 at the height of the last global financial crisis. And by the way, the majority of bank failures during the last banking crisis happened after 2008 and 2009, probably from the ripple effect to smaller financial institutions. As you can see here, more banks were wiped out between 2010 and 2013 than in 2008 and 2009. But the asset base that was affected was lower. Now, not every crisis is necessarily bank-related, as you can see from the lower number of bank failures during the dot-com bubble burst in the early 2000s. That time, it was the lofty startups that were hit hardest, not the banks necessarily. And as we in the industry never fail to mention, past performance is not necessarily a good predictor of what will happen the next time around. Having said that, quite a few of us in the industry are sitting on edge, myself included, because there are some blinking red lights that lead us to think this crisis may potentially end up looking more like the banking crisis from 2008 and 2009 than the tech crisis in the early 2000s. Here are the 3 blinking red lights that concern us. 1, the massive amount of safe U.S. Treasuries on bank balance sheets. And yes, these U.S. Treasuries are safe in terms of credit risk, meaning we can safely assume the U.S. will honor its obligations when they come due. However, the lightning speed of Fed rate hikes since March 2022 has massively impacted their current market value, and this can spell trouble for banks who need to sell US Treasuries or, frankly, any other type of safe investment security at the wrong moment in time, as we talked about in this recent video, which I've linked below. And while the total amount of unrealized losses on investment securities in the US banking system has come down a bit since its peak in the third quarter of 2022, it's still more than $500 billion, as you can see from these blue bars here. So I personally think this potential crisis isn't over yet, especially if we keep in mind that Fed Governor Powell has already suggested that 2 more rate hikes are planned for this year, which may create additional unrealized losses in the books of some banks. And be sure to check out our latest members-only videos if you're interested in learning more about the role credit risk and credit ratings play in the world of bond investing in terms of assessing default risk. Moving on though. 2. The goosebump raising rates offered by some banks on CDs and high-yield savings accounts as they chase deposits that would otherwise be flowing out to treasuries and money market funds. This will negatively impact profitability over time. While these rates are great for you, me, and all the other super savers and members in our community, it's not necessarily so for the banks, and those that can't manage their bottom line properly will not survive. The good news in all this for super savers and members, and the bad news for banks, is that the pressure on deposits is not going to go away anytime soon. Over the past 4 quarters, since the Fed started raising rates, U.S. banks have lost a total of $1,190 billion in deposits, with $472 billion, 40% of the total, flowing out in the first quarter of this year alone. Unless this trend reverses its course, I think we can expect continuing super saver-friendly rates on CDs and savings accounts, but also continuing goosebump raising pressure on the side of the banks. And last but not least, 3. Additional losses banks may suffer from their other lines of business, such as commercial real estate and corporate lending. Worries are growing that commercial property losses will add to banks' woes. Just think of all those gleaming and sparkling office buildings in the city centers and well-groomed office parks that don't seem to fill up anymore now that so many people have started working remotely. Throw on top of all that the general upward trend in overall corporate default rates. Basically, more and more companies that these banks are lending money to are hitting financial troubles and or going bankrupt themselves, meaning that some of the money that these banks have lent out to these failing companies, they'll not be able to get back 100% of. Independent credit rating agency Moody's recently reported that corporate defaults jumped with higher interest rates, slowing GDP growth, and financial stability risks. In fact, 15 Moody's rated debt issuers defaulted in March, the highest monthly count since 2020. And another independent credit rating agency, Fitch, also just lifted their U.S. corporate default rate forecast in 2023 and 2024. In fact, did you know that in mid-May of this year, at least 7 large companies filed for Chapter 11 bankruptcy protection in less than 48 hours? According to Bloomberg, this was the busiest 2-day period since at least 2008. And it shouldn't be a surprise, right? Bad economic times typically weed out underperforming or poorly managed companies, and some that are just unlucky as well, in the banking sector as well as in the non-banking sectors. So these 3 blinking red lights make the possibility of more bank failures later this year or in 2024 an increasingly bigger concern for us, which is a great segue into our next question. As I told a group of young professionals in June at a seminar on inflation, interest rates, and investing, there are so many things going on in our economy, our country, and our world that we cannot control. We can't control inflation. We can't control the direction of interest rates. We can't control if or when the next bank or banks will fail. But what we can control is this. We can make sure that our bank and our credit union are FDIC insured and are NCUA insured, respectively, And we can make sure that we stay below the deposit insurance limit of $250,000 per depositor, per insured financial institution, per ownership category. This is the most important thing you and I can do. That is what we can control. And if there are questions that you haven't found the answers to in these FDIC and NCUA 101 videos, linked below as usual, then the time to get your answers directly from the FDIC and NCUA is now, or at least before the potential next round of financial institution failures. Because the last thing you want to do is to be waiting anxiously on hold for hours with everyone else if and or when the next catastrophe hits. Here's the number for the FDIC and here's the number for the NCUA if you have further questions. And for those of us who are exceeding the deposit insurance limits or are still concerned even though we are safely within the insurance limits, those of us who have sleepless nights and are waking our woes about our bank and other banks collapsing, we can add a second line of protection by keeping our money with a g-sib. I feel like a broken record, but g-sibs are global systemically important banks, some of the largest and most influential banks in the world, and what we personally consider to be among the safest banks out there. Here are the 8 g-sibs in the US. Check out this g-sibs 101 video if you want to learn more about them. Because even though we know and do all of this here, and even despite the fact that the FDIC covered all depositors in all 3 bank failures that have happened so far this year, including those that were above the FDIC's $250,000 threshold, having our money in a g-sib just gives us an additional layer of protection, the second line of protection. It gives us that little bit more security and peace of mind that we need to go on with our everyday lives relatively worry-free, knowing that we've done everything within our control to protect the hard-earned savings we keep at our bank. There are no guarantees in life or in financial services and investing in general for that matter. But for us, keeping our money with a g-sib means that all else being equal, we know that our bank will most likely have the additional government backing, regulatory controls, meaning more capital and liquidity, and higher supervisory expectations in place to better weather the next round of potential bank failures than their non-g-sib counterparts. But that's us, our financial journey. And everyone's financial journey is different. For many, simply knowing that FDIC insurance or NCUA insurance is there is sufficient. And there's nothing wrong with that if that's you. There's also nothing wrong with it if that's not you. Check out this video here if you want more details on the questions you should ask yourself to see if a move to a g-sib may be the right one for you if you're concerned about bank safety. And for those of you who are trying to navigate the world of fixed income investments during these times of uncertainty based on your risk return profile, check out these latest members only videos for a deeper dive into what I personally view as an almost generational opportunity in the world of bonds. And pencil in our first live members Q&A in July. Click on this join button on our channel page or the join link in the video description below for more details. All right, Super Saver, as always, I hope this video was educational and that you learned something new. If you did, don't forget to share it with those you care about and to hit that thumbs up. And if you have thoughts on other great money topics we should cover in the future, drop a comment below and let us know. See you again very soon with more brand new wealth building content for your financial journey.